from this chart itself, you will then see that integrated development actually is the clear winner over here, even on the long-term basis, buying directly from the developer or even buying from the resale market, as well as in terms of rental yield, they are comparable to the other two asset classes. So over here, topic number one, we'll be diving on already. We'll be touching on what is mixed-use development and why investors favors them. So over here, we see many spotlights of integrated development. In fact, it looks like one of the hottest things right now, right? So one of the hottest assets class right now. So again, as early as 2018, we talk about spotlighting them as a premium. So-called, we're buying actually shell extra dollar just to buy into an integrated development. And even if so, is it worth it? All right. And even Stack Homes in 2021, year 2021, this year in July, they even picked up an ultimate certified mixed-use development. Where to find them, and of course their prices today as well. And of course, what are the allure of residents in the mixed-use development, along with the withstanding of the test of time? Okay, even though all mixed-use development, or I wouldn't say all integrated development in Singapore are all double 9 leasehold. Okay, so still withstanding the test of time, which is pretty intriguing. So next thing, we're going to talk about Canning Hill Pierce. All right. Over the last weekend, we see 77% sold out of 696 units, including a 48 million penthouse that was done. Okay, so very interestingly, this unit was done at an average of $3,000 per square foot, with the biggest unit penthouse close to 9,000 square foot done for $5,360 per square foot. All right, and interestingly, to note, all unit types were well received. There was no particular unit types that wasn't. So it's just the type of development that people are more drawn to. Okay, so is it worth the premium? Because we are looking at what PSF of $3,000, and even the penthouses at 5,000 plus. All right. So in the next slide, we talk about why mixed-use development, and in here we see a URA master plan. So in this master plan itself is broken down into 3 or 4 different color coding. Mainly, if we look at the beige color one, it says full-fledged residential development, which you learned in the first masterclass. And white color one shows integrated development usage, Grade A offices, or even hotel usage. And what we're going to dive on today is the 2 blue color side, which is mixed use and commercial. So over here itself, we see 2 color coding, the light blue and the dark blue. So the light blue itself is basically zoned as mixed use development in terms of land zoning. In terms of residential quantum, it has to build a minimum of 60% of the gross floor area as residential. All right, and on the commercial podium itself, basically they can only build up to a maximum of 40% of its gross floor area. Okay, and for the other land zoning, which is under commercial, which is the dark blue ones, we see that the residential component is basically determined by the competent authority upon submission. So it's by way of application. So there is no weightage on the percentage, but based on its commercial quantum, minimally they have to build 60% of the podium as commercial of this GFA. So these two are running at lopsided. Okay, and having said that, it's very interesting and good to know what kind of development or land zoning actually give you that kind of leverage in residential or if not commercial optimization in space. All right. So the next thing we then talk about the attractiveness in this area. We talk about the government land sales in the last decade, over the last 10 years. Okay. There were 24 mixed-use projects that was released by the government from year 2011 to year 2020, which is close to a decade. And out of 24 projects, 17 of them have outperformed the general market during its first month of sales launch. All right, and basically out of the 17 of them, 14 of them falls within the top 10 best-selling project list during the year when they were launched. All right, so throughout a 12-month period. So in these instances, we see this article itself, which is by John Slang. At the left side of the so-called chart itself, we see the percentage of number of take-up rates at the year of launch. At the bottom itself, we then talk about the different product as launch date. Okay, the black color dots refers to the annual take-up rate progressively. Okay, so for example, we talk about Bedok Residences where it's first launched, within its first month, it basically has 80% take-up rate. Whereas we talk about the rest of the development basically only have close to 50%. Right. So same for North Park, Points Residences, the Wisteria, Le Quest, Park Place Residences at PLQ, Sengkang Grand, and even the M at the Middlewood. Okay, so on the next slide, we'll talk about integrated developments. What are the integrated developments? So just now we learned mixed use. So mixed use development are basically a residential sitting on top of the commercial podium. And then we talk about integrated is where it comes with a bus interchange. In this instance, MRT. All right. So these are we talk about investors out there. They are willing to shell out at least 7 to even 19% premium comparing to a leasehold residential development for such asset class. All right. So in this instance, we see 15 projects over here. These are all integrated development by way of the MRT. And of course, out of that 15, we actually note that there were also 8 of them that comes with a bus interchange as well. Okay, and the first one is basically campus height as early as year 2001 when they first launched. Okay, and we talk about integrated development. They are of average size of 400 to 700 units, residential units. And the smallest one being Orchard Residences at 175 units in size. And we talk about Marina One being the largest at 1,042 units. And this entire integrated development asset class forms less than 3% of the entire housing supply in the GLS program altogether. So it's a very limited edition kind of so-called property type. And the different forms of integrated development over here, very important, and this is some education so-called series for you. So if you look at it in the good old days, integrated developments are actually introduced as early as in the year 1990s. So how is it being formed? How is it being introduced back then? Back then it was on individual parcel. So what it means is that if you look at city square residences, of course, we talk about its condominium actually sits on one land parcel altogether. And then you talk about the mall itself, which is City Square Mall, actually sits on another parcel. And then we have the MRT, which is the so-called Farrer Park MRT train station that sits on its own, which is an underground train station. And this is how it looks like. And this takes up a lot of space. And this is not very efficient use of space altogether on prime lands like that. Okay? And then of course the URA planners evolve along the way. And then we see an upgrade of such concept. We then have the residential sitting on top of a commercial, and then we have the MRT at the side. And for this, we have the illustration over here called the Watertown. Okay, so Watertown itself, same thing. Basically, we have the residential component sitting on top of the shopping mall, and then we have the MRT that's across the road. Okay, along with the bus interchange as well. And then next thing, we then have commercial, residential, and bus interchange stacking on top of each other. Okay, so how does this look like? Basically, we are talking about Bedok residences. We have the residential component, the shopping mall at the bottom, bus interchange, and then the overground MRT called what? Bedok MRT, right? Okay, and this is how it looks like. And then finally, we then talk about fully integrated development, which again was the first integrated development that was introduced by URA, and that is campus heights. We have all under one roof. Okay, residential at the top with the other 3 components at the bottom as well. Okay, so this is a quick backstory on is integrated development worth the premium? And this is shared by basically Simon Yong, one of the Chief Development Officer of CapitaLand. So do take a quick peek on this to understand why the premium and is it worth it?
With the government building more MRT lines, there will be more MRT stations, and the land around the MRT stations are logical move towards the integrated development. Okay, and that is the only way to also maximize the land use and to maximize the value.
In general, integrated developments are more costly to build. Developers of integrated developments need to take into account things like how to connect to the MRT station or bus interchange or to other facilities.
Construction costs, yes, will be higher, that's for sure.
Land costs will be higher too, as developers compete more aggressively for these prime sites. But CapitaLand says that integrated development apartments offer good value.
Want a premium product, you must be prepared to also pay for it. Everything is a doorstep. Basically, you save time. You don't have to travel too far out. And that saving in time can be translated to quality of life for the individual. Okay? And to me, That is the value of owning a home in the integrated development. The other aspect is actually good investment, good rental potential. I think you can rent out the interior development home easily.
So hearing from the horse's mouth himself, he's sharing that basically, first thing first, the construction cost of this integrated development are a lot more higher in terms of premium. Even the land itself are tendered at a higher price. So if you realize the recent so-called launches or even land bidding that was won, CapitaLand has actually joint venture with CDL for many so-called integrated development land tender bidding. So Sengkang Grand is one of them, and of course in recently, so over the weekend as well, which is Canning Hill Pier. So again, CapitaLand is one of the pioneer developers that are on the lookout for this kind of asset class in the current sentiment altogether. Okay, so next thing, we then talk about the performance of different assets class, and in these instances on the left axis we see prices in PSF, and then we are using 4 different timestamps for this illustration. First at launch date, then November 2018, and that is basically just after the so-called cooling measures, and then 2021 January and November 2021 as well. Okay, so over here we see the different development in different asset class. In this particular first box, what we see is the integrated development class. And then secondly, we have the mixed-use development class that you learned just now. What is it? And then the third one is full-fledged residential development. And all these development are basically done between me and my team. We choose them within the close proximity of each other given its asset class type. Okay? So most importantly, what you want to take note of is what is the capital gain from its launch day till today. So different development has different so-called runway, and of course with a longer runway you have a higher capital gain. So in this instance we see a few outliers here that basically run through this notion of so-called concept that I just shared with you. So Compass High itself, we have about 80.6% capital gain from launch day because it has one is the first so-called integrated development that was launched, followed by the Centro, which is in 2006, the one in Jurong Lake, okay, Boon Lay area. All right, so with that 116.6%, even though it has just a shorter runway of about 4 to 5 years, okay. And then we also have the Icon as well, that was in year 04-05 at about 126.6%, okay. And the rest was doing averaging at about 3 to 6%, or some even 10% as well. All right. So the next thing we then talk about its performances in average throughout its sector. In integrated, we did 26% all in all. In the mixed-use development context, we have 17.2%. On the residential component, we have 6.4%. All right. And then we then talk about the capital growth for the last 3 years from year 2018. Why 3 years? Because we're using in the notion, in the event you want to buy something and you need to abide with the seller stamp duty, you will need to take 3 years to liquidate these properties. Right? You can only liquidate 3 years later before subjected to seller stamp duty. So with that, this is an instance for buyers who are looking for immediate cash flow, thinking that rental yield is very good for integrated development or mixed-use development, and it's very easy to rent out as shared by Simon Yong just now. What are the so-called performance, how it looks like in its resale level. So basically, this is how it looks like in terms of capital gain over the last 3 years. And then we then talk about the rental yield. Basically itself, this is going about 3.1 to 2.2. So not much difference altogether between that 3 sector altogether. Okay. So most importantly, from this chart itself, you will then see that integrated development actually is the clear winner over here, even on the long-term basis, buying directly from the developer or even buying from the resale market, as well as in terms of rental yield, they are comparable to the other 2 asset class. Okay. So next thing, which investor profile is the best fit for mixed use or integrated development? Because different buyers have different so-called equities and of course runway and needs. So what the profile actually best fit this kind of investment? So over here we talk about buyer's profile of able to assess a unit type of 2 bedrooms and below. Okay, and we talk about smaller units over here. Usually this nature of buying, we talk about smaller units are having lesser liquidity because we are open up to a smaller pool of prospect when it comes to exit, right? So next thing we then talk about investors with such budget, lower budget, usually focuses a lot on affordability and rental yield. Okay, so next thing, when affordability is key, integrated development actually fills in this gap. 1, Because very simply, if you look at Centro and also Watertown, which is at Punggol, rental yield is preserved when you buy the small units comparing to the big units. So in the big units type, all unit we look at across the board from small to big, averaging at about 2.8% in rental yield. But the small units, if you buy anything that is 2 bedders, in fact, the Central smaller units is 2 bedder, is at 2.9%. And for the Watertown itself, same thing, all units start is 3.1, but you buy the small unit, you get 3.3. And in terms of strong resale demand and capital gain, all right, how does it fare? In the average for Central, all units start at 3.6% annualized gain year on year. But if you buy the small unit, you actually get about 5%, which is 1.4% more. And then when you buy Watertown, it's about 2.4 across all board. But when you buy the small units, it's basically 2.3, not too far from the average. Okay, so in this instance, we talk about diving in deeper. We look at the Centro itself. How does it look like? Basically, Centro itself, its location is located, again, just like City Square, a parcel each, right? So we have the Centro basically sitting over here next to the Ang Mo Kio hub and also across from the overground of the Ang Mo Kio MRT and also the bus interchange as well. All right. So this development is actually a double 9 leasehold development from year 2007 and 329 units completed in 2014. So with this, we then look at the average rental yield analysis in the last 6 months. And if you look at it, the smaller unit types of 1,000 square foot and below, or even 800 to 1,000 square foot, we has the highest number of rental contract done. And even in terms of transaction, 4 units were done between 900 to 1,000 square foot altogether. And to share the smallest units size in this development, it's 700 to 800 square feet. Okay, so back then in Ang Mo Kio, when they first launched, there isn't a 1 bedder available. Okay, and you look at this chart here, we talk about profitable transaction. Okay, it is 75 profitable transaction here, and this chart itself is lined up in terms of capital gain sensitivity, which is its annualized gain year on year. So in this instance, we see that unit type that are, which is the square footage here, that are 900 square foot and smaller forms up at least 80% on the first page of growth. Okay, so small unit type actually commands stronger growth in this instance for Centro. So next we then talk about the average annualized profit, 3.6% for all types. Again, for a small unit, you get about 5%, as you can see from the chart here. The next thing we then talk about Watertown. Watertown itself basically, again, sitting on top of the commercial podium and also across from the bus interchange and the MRT. So this is a double 9 leasehold development from 2011 and completed in 2017, and 992 units development, quite a big size for an integrated development. So average yield analysis over here, rental yield, last 6 months, what we see is that the smallest unit type from 500 to 600 square footage, we see 72 rental contract done. Okay, and in terms of transaction in demand, resale, 13 units done altogether in just 6 months. And the rest of the unit types are actually a lot more lesser. And in terms of the profitable transaction, a staggering 171 transaction profitable. And in terms of rental, we talk about annualized gain altogether. We are going in terms of sizes. Any units that are 600 square footage and smaller, we forms up at least about 35 to 40% over here. Okay, and they are on the first page of growth. And we're talking about 5% growth all in all using the average so-called analysis. So all unit types, again, 2.4 for in terms of growth. Small unit types 2.3. Okay, but of course on the top chart on the first page here, you see we are going at about 4.4 to 5.6%. So the right product fit for budget-sensitive investors for integrated development. So for investors who are, or buyers who are conservative about having maximum bank leverage, because some of them just don't want to take so much loan, right? They want to down pay more. Okay, we talk about integrated development actually gives them optimum return, even so, because you are buying smaller units. Okay, so smaller units also enjoy comparable ROI, especially so comparing to a non-integrated development. That means a full-fledged residential development. And with that, we also talk about equity-wise, your down payment would be a lot more lesser. Even though it's way lesser buying a smaller unit, you actually enjoy the same benefit if you buy a big unit type on a full-fledged residential development. So in short, integrated development actually gives both capital gain and strong passive rental income. So if you're looking at both, this is the only asset class that can give you both, because everybody wants strong rental yield at the same time strong capital gain, right? But selecting the right unit type is very important in this instance. If you select the wrong unit type, then it's very hard for resellability.